Well, hello everyone and welcome to Momentum channel. My name is Mohan, and in this video, as part of the Blossom portfolio review video series, I have two more portfolios to go through. And at the end of the video, I'll be sharing my own portfolio that my wife and I have built, how that portfolio is doing, and where things are at with it. Without any further ado, let's get into it. All right, the first portfolio for us to review is from ABI TBI with the handle on Blossom Edamame. I'm not gonna lie, when I first came across this handle, at first it reminded me of the edamame, the Japanese dish from the soybeans that I love. And it's funny how it kind of, there's some similarities in your username. Thank you so much for this opportunity to review your portfolio. I must say, when you commented on my earlier post asking me to give your video a try, I was very happy to see that, and I'm super happy to go through your portfolio right now. First things first, as we do notice at the time of making the video, the all-time return for your portfolio based on what we see on Blossom is at negative 1.8%. Not terrible, but you would hope, of course, depending on how long you've been investing in market, ideally always would like to see some positive returns. But let's dive into your actual holdings and see what it kind of pans out and what does it show to us. When I listed your holdings based on the all-time return, the best performing ones in your portfolio currently are VFE, which is up by 8.7%, nice. HXQ, which is up by 3% plus, again nice, gives you exposure to Nasdaq. And then third one is XEC, which is up by almost 1.7%. Then looking at the bottom of your list based on the worst performing ones, we have the Purpose Bitcoin ETF. I know that it's one of your smallest holdings, but that said, it is showing to be down by close to 45%. Then we have Fiera Capital. It's relatively as well a smaller holding of yours, but it's down by 33%. And then we have Brookfield Corporation, which is down by 14%. Now let us move on and take a specific look at all of these holdings, where they are at, their breakdown by sector, and some of the key observations that I had here on this portfolio. What I provide and share here, of course, is not financial advice. It's merely my 2 cents based on my experience investing in the market and some of the things that really stand out for me and some of the things that to me are positive. So I would like to kind of bring them to everyone's attention as well. I've listed right now all these holdings from their largest exposure to the lowest. And as you notice, as I pointed out, VFE is the biggest holding here, which is up actually by the largest as well, around 8%, and it accounts for 31.3% of this portfolio. The second big holding is TD. Following that, we have Enbridge. And then the fourth spot, we have VDY. Looking closely at these ones, your top 5 holdings, the fifth one being Fortis, account for close to 80% of your holdings. Something to keep in mind, how you're concentrated in these top 5 holdings as opposed to the rest of them. In total, what I noticed is that you have 17 different holdings in this portfolio. It is really, when it comes to number of holdings in the portfolio, it really can be personal. For me personally, based on my own experience, I love to always keep this number to maximum around 10 to 15. It just makes things easier, especially if I'm considering to add stocks, because that requires a lot more thinking, a lot more research, a lot more following the company performance, listening to conference calls and whatnot if you want to do it right. That's something that I wanted to share with you. The other thing is based on the sector breakdown. As you look at it here, the largest exposure for you is ETFs, around 48% or 50%. For me, as an investor who's almost every percentage of their fund is in ETFs, I'm totally fine with it. I find index investing one of the best ways for many investors to invest in the stock market without the hassle of having to do a lot of research, and really going for the average market returns, which in many ways is with patience and discipline is the best recipe for success without having to really worry about other stresses of the market. Your second big holding is to financial at around 30%. It is one of the, and of course all of these are Canadian financial sectors. It's one of has been historically at least one of the most robust sectors in the market. And you have those big banks in your portfolio, including Toronto Dominion Banks as well as Bank of Nova Scotia, as I noticed it here. The holdings that are highlighted in white color are the ones that are already available through VDY ETF. VDY is a basket of dividend paying Canadian companies, around 57 of them, and these 4 of them appear in VDY. Hence, holding them separately may not always be warranted unless you really want to get a higher exposure to, for instance, any of these single companies that you are invested in. As an example, if you look at the holdings for VDY, you'd notice right off the bat that the top holdings include Royal Bank of Canada, then you have Enbridge and TD. These are among the top holdings, and Bank of Nova Scotia is as well among the top 5 or 6. For me personally, my recommendation is, if you don't see a strong reason as to why you're holding these unique companies separately, you might as well just over time get rid of them and maintain your position in VDY. Keep things simpler, make it easier for you to think about things, and you don't have to worry about so many different holdings and that you have in your portfolio. That's one recommendation for you to consider. The other thing is that might also allow you to manage your exposure to the financial sector a little better. Keep in mind, with the VDY, it has more than 50% of its exposure to financial sector alone. So around 52% of VDY's holdings are exposed to financial sectors. Right now you have about 8% of your funds in VDY. So keep that in mind. And on top of that, if you think about it, you also have some exposure to financials. So you're adding on top of that to already strong exposure that you have to financial sector. Whereas if you just potentially either keep the stocks in financial sector or hold your position in VDY, you're balancing it out a little bit better. A few other things that I did notice was you have shares of XIC, which funny enough, I also have shares of XIC in my portfolio. And a lot of times I get asked, why do you need to maintain ETF of XIC when you're already having VDY? Well, with VDY, we are focused more so on the dividend income. You're focused more on the like around 50 or 60 Canadian companies that pay good dividends, but you're not getting exposure to the rest of the Canadian market. There's so many amazing companies out there that in Canadian market that are not paying dividends, like Shopify as an example. And if you just invest in VDY, you're going to lose your exposure to those amazing businesses. Through XIC, you're virtually getting exposure to the entire Canadian market, and that's why I like it as well. And I use that personally as a way to supplement and complement my holdings in VDY. I like your positions there. You may want to consider over time increase your exposure a little bit as well. I haven't looked at this analysis, the breakdown by geographical exposure. That's something that you might want to consider as well. When I talk about geographical exposure, I'm talking about how much investments are you having in Canadian businesses, how much in US businesses, how much in international businesses, and how much to emerging markets. In this case, it's from the sound of it, it looks like the majority of your investments are in Canadian and US, though I did see a few things that I liked. One was that you have exposure to the emerging markets through XEC. So through XEC, which is one of the ETFs that I also have in my portfolio, you can get a higher exposure to emerging markets. It's a good way for you to diversify your portfolio. I really like that. You just may want to over time gradually expand on it. 0.8% is barely enough exposure, I would say, to emerging markets. For me personally, just my 2 cents, I have an exposure target of 10% to emerging markets. The other thing is getting some exposure to international markets. I did notice that you have as well shares of XEF, which funny enough, I also have it in my portfolio. Currently, you have about 2% exposure to it. For me, I have a target of reaching 25%. Again, I'm not saying that you have to exactly follow the targets that I have, but just sharing some numbers to put things into perspective. If you want to get some exposure to international markets, maybe you want to bring it up a tad bit from that 2%, because 2% seems to be quite small exposure, I would say, to international markets. And the last one point I would make here is I did notice you have some exposure to the Bitcoin ETF. The cryptocurrency is not an area that I'm really the biggest fan of. I used to dabble in it, but definitely learned my lesson. But at least I'm glad that even though it's your worst performing holding, at least you're not into it heavily. You're only less than 1%, around 0.5% exposure to it, which if you treat it as a play money, then it might be something that totally acceptable as well. Thank you so much, Emame, for this opportunity to review your portfolio. I would love to hear from you. Is there anything that I shared with you that stand out for you? Anything that you agree or disagree with? Let me know what you thought. it was suggested last video that maybe I try to fit in more than one portfolio review in one video. So that's why I'm going to go ahead and review one more portfolio here. And this one is from Ayush. And he actually commented on one of my posts saying that, his portfolio is very simple, only 3 positions. So if I can't fit it in one of my existing reviews, that's why I've done. Thanks, Ayush, for the recommendation. Let's get into it. I must say, I love your setup. It's simple, yet practical and to the point. You only have 3 holdings. Majority of your exposure is around 72% is in XEQT, which for investors who may not know, it is actually an all-in-one ETF. It's one ETF that through that, you're getting exposure diversified to various markets and a ton of companies out there. You get exposure to the US markets, Canadian markets, international markets, and emerging markets all in one, just through this low-cost ETF. I love that. And even though I don't have XEQT in my own portfolio, I have one very similar to it, which is Vanguard version of it, VEQT or VEQT, and it's part of my Smith Maneuver portfolio. Your entire exposure is to ETF investing, just pretty much like what I have. Your next big holding is HXQ, which is closely followed by VFV. One of them is Horizon Nasdaq 100 Index ETF, and the other one Vanguard S&P 500 Index ETF. Amazing holdings here that you have. Through HXQ and VFE, you're getting exposure to US market, of course, but in Canadian dollars. And one is focused more on more of a growth-oriented businesses through Nasdaq 100, and the other one S&P 500, which is again geared towards growth, but around 500 largest companies in the US market. Actually, if I were to provide some feedback, I absolutely love your setup. With XEQT, you're already getting that exposure to the various markets. One thing that stood out for me is that with XEQT, around half of that exposure is to US markets. So if you think about it, half of the 71% accounts for around 30 to 35%. Then you have HXU and VFE, and they are fully exposed to US market. So add that on top of that, another 28 to 30%, 30 plus 30. So you're getting around exposure to that 60 to 65% exposure to US market, and the rest of it to the rest of the world. To me, it sounds good. If you want to perhaps over time lower a little bit of your exposure to US market, you could possibly add one more, potentially ETF to the mix. But it's totally optional for you. If you wanted lower US exposure, you could put in another ETF in there that maybe gives you a little bit more exposure to Canadian markets, or possibly, let's say, maybe to international markets or emerging markets. It's really your call at the end of the day. All in all, though, I must say I love the simplicity of your portfolio, and I think you're on the right track. I think just by maintaining this portfolio, adding to it over time, and discipline, you are definitely on the path to building a nice portfolio for your financial future and helping you reach financial independence. Just gonna quickly provide a few highlights from XEQT, because I did mention it for folks, that's why I love that. Year to date, it's up 11%. It is an all-in-one ETF. It hasn't been around the longest. You do see the annualized return over the past 3 years, on average 11% per year. Since inception of it, it's also annually returning 9% plus, which is just amazing. The inception date for this one goes to August 7th of 2019. It does pay a dividend distribution on a quarterly basis with an annual yield hovering around 3%. Nice. I like what I see. I want to also point out the underlying holdings that mainly consist of 4 different ones. It has a very low fee at management expense ratio MER of 0.20%, and it consists of these other holdings as part of it. What's the beauty of the XEQT is that it also consists of XIC, which we touched on earlier in the video, focused more on Canadian, XEC, which is focused on emerging markets, and XEF, which is focused on international one. Plus it has ITOT, which allows you for the total US stock market. Just the beauty, all of those ETFs combined into one basket for easy investments, and the geographical graph, that exposure that I showed you earlier on as well. Lastly, as I promised, I'm gonna walk you through my own portfolio. This is the portfolio that my wife and I have built, currently showing a total value balance of $478,000. This number has dropped a little bit, even though our portfolio has done actually quite well and grown in terms of the market return. one of the reasons is that I did sell all of my holdings that I had of VFV in my registered retirement savings plan, and it was not that many of them in there. It was only 153 of them. I sold them at a profit around, I think, 12% or so gain, and used the money partly to add to my position of VDY. Also, I'm kind of contemplating how I'm going to use that money in my RSP account. One of the key options that comes to my mind is converting it to US dollars, so that in my RSP account, I can actually buy some shares in shares of ETFs in USD to avoid paying for that 15% withholding tax for US stocks when you're holding them outside of an RSP. So that's one of the game plans. The only thing that's kind of stops me or slows me down is that when I'm trying to convert it in my Wealthsimple account to USD, even though I have a Wealthsimple premium account because of my size of my portfolio, still there is that conversion fee of the US dollar conversion from Canadian to USD for around, I was last when I checked it, it was costing around $180 or so for approximately $14,000 worth of Canadian dollars to be converted back. I've used some of that funds since then to use and buy more shares of VDY in Canadian dollars, but right now I have another $10,000 to $11,000 Canadian dollars sitting in my RSP account waiting to be decided. If you have any suggestions and thoughts for what could be a good addition to this portfolio, let me know. Of course, I will do my own due diligence before I buy any of those shares or anything like that. But yeah, I would love to as well hear from you what type of perhaps holdings you have in your RSP account that you would recommend. I'm not personally leaning as much towards individual stocks and more so interested in ETFs. So if you have any good ETF recommendations for RSP account, let me know. You can see quickly here the best performing holdings right now for us is VFE, up by close to 13%. Following that, we have VTI, which is another US kind of total market index ETF, up by 9.3%. VTI is in US dollars and we hold it in our RSP account. Then we have XEQT up 7.7%. And following that, we have VT, which is the Vanguard Total World Index ETF, and we hold it in our RSP account. It is also in US dollars. VT is up by almost 6.4%. The other holdings that we have in our portfolio is XEQT that I talked about earlier, all-in-one basket ETF up 4.8%, XEF up 3.6%, XEC up 3.1%, and QQC, we only have one share at this time. We've started adding it gradually. It's up 2.7%. With QQC, I'm kind of contemplating because actually I bought it in Canadian dollars, and recently on Blossom I saw some posts from folks. I think it was Bradley that was talking about the difference between holding shares in US dollars in RSP or the Canadian dollar version of them elsewhere, and then you have to kind of accept that 15% withholding tax when it comes to the dividend distribution. So that's something for me to consider, which is why I haven't really dove into it as heavily in the QQC. Plus the markets are pretty much at their all-time high. So I'm not going to rush into buying more shares right off the bat without any patience. I'm going to wait and see how the markets react over time and hopefully wait for a better opportunity to deploy those funds into the market. And the two funds that are currently negative, XIC is just 0.1 percentage point negative, and VDY, which is down by 0.7%, not even a 1 full percentage point negative. The fees for the management expense ratio for these funds that we have are showcased here. And of course, the number of the expected dividend income from each one of them that we have are also showcased here on this. There you have it, folks. A quick look into the two portfolios on Blossom that we reviewed. I hope those folks that kind of had their portfolio reviewed found it beneficial, and for you as well, hopefully provide you some insights in your own portfolio. If you're interested in having your own portfolio added and reviewed on these video series, let me know in the comment section down below on YouTube or on Blossom. And of course, subscribe to my channel on YouTube. It really means a lot to me and helps me to grow Moementum Finance and have more like-minded folks joining the journey towards reaching financial independence and financial freedom. Thank you, and I hope to see you all next time.